Good morning to you both. Margie, I'll start with you. The comments that Steve just made about there really being two places to go, given the hotter than expected PPI number we got this morning and those wholesale prices, either consumers or to companies' balance sheets. How does this play out if inflation hasn't, in fact, peaked? How does this now play out for the markets at a time where you do have all of these different cross currents, macro cross currents that investors are having to navigate?
Well, we've never been exactly in this situation before in previous cycles. But the way I look at it, even though there's been supply bottlenecks and pricing pressure for this latest quarters and looking out for companies' expectations, they still are very optimistic. They've been able to hold these wide profit margins. They've been able to either increase their prices, improve their productivity, or handle their supply bottlenecks. So that says to me that corporations are in pretty good shape to handle this. I think we're really in the benign part of the inflation curve where most of the effects at this point are good, meaning corporations have maintained their high profits. Consumers have gotten increases in their wages, but they haven't felt the full impact of all these price increases affecting their real income. And so I think actually the economy will continue to chug along, especially with the Fed continuing their policy of being too little too late. They're still buying government securities incredibly at this point with almost 10% inflation. It's really amazing what they're doing.
It is really amazing. Megan, want to get your thoughts on this and how you're balancing it against some of the geopolitical risks out there, given the fact that if Russia were, heaven forbid, in coming days or coming weeks to invade Ukraine, that's just going to add to the inflationary story.
Yeah, Morgan, that's absolutely right. So particularly as you think about the regions that are most exposed to the Russian-Ukraine tensions, which would be Europe, Germany in particular, inflation over there has been driven by a bit of a different mix than inflation here in the U.S., where we had so much more positive monetary stimulus, fiscal stimulus that really contributed to goods inflation. Over in Europe, it's been much more centered around higher energy prices. So I think for that region in particular, it's really important to see how the Russian-Ukraine tensions transpire. But assuming, that we don't kind of move to a worst case scenario, I think the outlook for international equities, as well as here in the U.S., is fairly solid. We're not expecting equity gains like we saw over the past 3 years, but we think companies still have pricing power to pass through to consumers. Consumer sentiment is something to watch. So it's really going to be, I think, a stock-specific story type of market, a stock pickers market, if you will, where those companies that have the brand loyalty and the pricing power are where you're going to want to be.
Margie, wondering about what message you think we should take from the credit markets right now, given your focus for so long in the high yield area. Lots of outflows from corporate debt, seeing spreads widen out a little bit. Is that just the market getting stress tested for what the Fed is going to do, or are we gearing up for something a little more negative in the economy that could undercut equity valuations as well?
No, I think the high yield market actually looks quite good. And it's the yields have gone up a touch because treasuries have gone up. But you're looking at an economy where defaults in the high yield market is only going to be about 1%. So that's very low. You'll get to keep all that extra interest income. And also, with higher inflation, that's really a friend to highly indebted companies because they'll be able to pass on some of that price increase with their very high fixed costs. So I think that's why high yield looks like it's a pretty good market here. It's off maybe 3 to 5 points year to date, so a little less than equities, but a yield of, say, 4 to 6% looks pretty attractive for an income-oriented investor because I don't think defaults are going to be an issue for quite a long time in the high yield market.